Thank you. So what's up, everyone? My name is Max. I'm the head of speakers at Cornell Blockchain, and I'll be moderating this panel. So first of all, thank you all for attending the Cornell Blockchain Conference Bitcoin panel. And we're delighted to have Dr. Yang, VP of Mining at BitMining Limited. He's also a Cornell alum. We have Mr. Brian Rudick, a senior strategist at GSR. We have Mrs. Susan Joseph, CEO and co-founder of HealthTrends.AI and executive director of the Cornell FinTech initiative. And we have Ms. Gina Abrams, chief of staff at Trust Machines. So let's get started with some self-introductions and how do you get into the Bitcoin space?
Hi everyone, welcome here. I'm Yui Yang. I'm a Cornell alumni, as Max said. I did my PhD at Cornell Applied Econ License School in 2017 to 2021. And that's exactly where my Bitcoin journey started from Cornell, which my research mostly aligned with Bitcoin crypto in my dissertation. And after that, I was in a financial company called StoneX, doing mostly digital assets trading for institutions. And then came out to be BitMining Limited, a public traded miner. BTCM is our ticker, and mostly doing crypto mining, revenue management right now, and all in Web3 now.
Hey everybody, my name is Brian Rudick. I head the research effort at GSR. We are one of the largest crypto market makers and trading firms in the digital asset space. In a previous life, I was a hedge fund analyst and I covered bank stocks. And it was really some of the banks that were the fiat on-off ramps that are unfortunately no longer here, but that's when I went down the crypto rabbit hole. Really strongly believe that this is where everything is going to go, even if it takes many years. And so wanted to move into the space and excited to be here and on the panel.
Hi, everybody. My name is Susan Joseph. I am the executive director of FinTech at Cornell. I'm also a lawyer and a consultant and a Cornell alum. I found blockchain and Bitcoin about 2017 when I was general counsel at a receivables insurer. And I started to have to manage data and transactions all over the globe. And it was increasingly difficult to do that in the disparate systems. So for me, I started exploring, and this made perfect sense to me from an enterprise standpoint.
Hi everyone, I'm Gina. I'm chief of staff at Trust Machines, where we are really focused on building Bitcoin applications and products. So we have a Bitcoin wallet called Leather. And I've been in the space similarly, class of 2017, and have been sort of contributing to what eventually became Bitcoin Layer 2's open source protocols, and really excited to chat more about Bitcoin on this panel today. Thanks, Max.
Thank you for all your introductions. As you can see, we have representatives from the mining space, from the traditional finance space, from the law space, and also from Trust Machines, which is a tech space. So excited to moderate this panel. So okay, let's start off with the most popular topic in hand, halving. So for those who don't know, halving cuts mining rewards in half, and it happens every 4 years. So last Saturday, mining rewards got cut from 6.25 to 3.125 Bitcoin per block. So my question today is, how is this halving different?
Thank you for the question. It's a very in-time question regarding the halving. It was only last week. And it definitely impacts our business as mining, which revenue basically cuts in half because the rewards cut in half. But in reality, it's actually a little bit better than half because of the layer 2 transactions. The fees, gas fees are accumulating among this network, which is helping a little bit 20% more than what we expected for the after the halving. So right now it's probably 72%-ish compared to what we had before the halving. So it's not as bad as halving, which is layer 2 and all the online on-network transactions helping along with the fees. So there's a difference that we see this time, and also obviously the Bitcoin ETFs and all the institutional investors are getting into the space, which is also different for this one. So we might see a more mainstream allocations into the assets, and also the participation in the mining space, as well as the new energy, clean energy has been helping along having the more flexible mining in supporting the space. So that would see that's what I would say the three major differences I would see. So Brian.
Yeah, I would just add from a markets perspective, there's two things in my mind that are really different right now. One is if you think about the marginal decline in inflation, it is now unfortunately fairly negligible. So if you think about it, 2012, the Bitcoin block reward went from 50 BTC to 25 BTC. That equated to roughly 25% inflation, actually moving down to like 12.5% inflation. So a big marginal decline in protocol emissions or new Bitcoin supply. And then what you're seeing now is the 6.25 got cut in half to 3.125. That equates to roughly 1 or 2% inflation going to 1% inflation. So unfortunately, in my mind, there's less of this underlying fundamental reason for Bitcoin to outperform. The second thing is if you think about where Bitcoin went in entering the halving, it was near its all-time highs. And so this has never been the case in the past. So like in the past, the highest it's ever been relative to its prior all-time high was like 60%. And this time it was near its all-time high. So maybe some of this outperformance got pulled forward with the ETFs. That said, I do think like the halving has historically been very, very strong for impacting Bitcoin's price. And Yue mentioned a couple reasons why it could outperform. So we have a ton of innovation occurring on Bitcoin. Runes actually launched at the halving, which is helping to support fees, which the miners are collecting. And then the second big reason why this is different is just access. So a lot of folks can now gather and gain access to Bitcoin in a much easier fashion through the spot ETFs.
So I have a slightly different view. I don't necessarily know that the technical part of the halving is any different, and I think that's good. Because that's the trust in the system, that the system and protocol works, the monetary policy works the way that it was instructed to. And even with all of the interest from Main Street Finance and the ETFs, et cetera, none of that impacts how the protocol works. So I think it's just further proof that the protocol works the way that it's supposed to. With regard to the ETFs, I think that what's different is an opportunity to educate more people, because more mainstream finance is looking at the ETFs. I think it is sort of the watershed moment for any crypto, because it's the first traditional large-scale product out of the world's largest asset manager, BlackRock, and then Fidelity, et cetera, Franklin Templeton. You've got these big household names who are understanding and trying to promote what they've got, and that requires education. So in that sense, the halving is much different this time because it might start to become a household word.
Yeah, all great points. I think the one thing I would just echo and reiterate is the fact that the halving event is a time that sort of the most mainstream attention is on Bitcoin. It's been likened to essentially this every 4 years, there's a Super Bowl for Bitcoin. Everyone's eyes are on it. And I think that this cycle is a little bit different because there's been this wave of, there's a difference in terms of the just mentality around Bitcoin. For a long time, Bitcoin was looked at as kind of just this digital gold that was essentially supposed to be really passive. But I think what we're seeing is that builders are really interested in actually building on Bitcoin, bringing productive use cases to life for Bitcoin, and sort of tapping into that liquidity, that community, all of the benefits of decentralization, security, and really want to see more built on the Bitcoin network. And so we're not only seeing in terms of folks looking at the price, but also looking at developer activity, looking at projects and innovations both on the L1 and the L2, and wanting to put that Bitcoin to work. So I think that's a very different sort of mind shift from previous cycles.
Thank you all for your insight. So like to sum it up, this halving is different because there are innovations happening on Bitcoin, such as Rudick. The applications are being built. There's institutional interest now, and like Bitcoin is at all-time high, like at a very high level before halving. So like these are differences. And to dive deeper into halving, what projects or events are happening on layer 1 or layer 2 to ensure Bitcoin's long-term sustainability?
I think there's not only one, but there's multiple or even more to come. Like there's Ordinals, BRC20s, and Ruins, and also there's Babylon. All those different Bitcoin projects are helping kind of building the ecosystem. So I would say that that's the trend for Bitcoin is not kind of slow in innovation. What other people are saying in last circle was Ethereum booming so fast. I think Bitcoin is just more stable and more slowly steady, but very kind of reliable innovation that's coming. So I would say that's the trend for building and on the Lightning Network with layer 1 and layer 2, those kind of helping the scalability and the reliability. So that's what I would see the good trend, but I will leave the kind of specific ones for other people.
Yeah, in my opinion, I kind of group it into 3 different categories. So Casey Rodamore came along and created this ordinal theory, which is like this Bitcoin meta protocol, which you can kind of overlay and as a way to view the Bitcoin blockchain to where you can actually track each individual Satoshi. So each Bitcoin has 100 million Satoshis. It uses a first in, first out, and you can actually look at it since the time it was created by miners like UA. And so what happened was you had a couple key upgrades in SegWit and Taproot that allowed you to inscribe arbitrary data onto a Satoshi. And at first, what happened was folks created these NFTs, inscriptions, essentially. And then along came someone named Domo who created something called BRC20s, which created like this fungible token protocol or standard on Bitcoin. So those are the first 2. And then the last category in my mind is really just Bitcoin scaling solutions. So Bitcoin and Satoshi intentionally limited its functionality, which really, in some respects helps to drive its value by having this narrow use case. But I think what you're seeing now is there's a ton of benefits to actually unlocking and adding utility to Bitcoin. I would say number 1, there's 1.3 trillion in idle capital just sitting there, and we can actually make that a productive asset. Number 2, you could take advantage of Bitcoin's leading security and decentralization. Number 3, folks are finally like on board and supportive of doing this. And then number 4, it seems like we can actually do this in a trustless manner potentially through BitVM. So when folks talk about Bitcoin scaling solutions in L2s, it's a bit different than how like the ETH folks talk about it, but I think we could potentially get there through BitVM. And then lastly, in my mind, the reason why this is so important, and maybe we have to do this, is because Bitcoin's Achilles heel is really its declining security budget. And so maybe Bitcoin's price can double every 4 years, but we're really relying on paying, folks like UA on this exogenous variable that, we don't really control. And so this is a way to actually cause greater utility for Bitcoin and could help facilitate this handoff from block rewards to fees to help compensate the miners and ensure Bitcoin will be around for many, many years to come.
Well, that pretty much sums it up. I don't have much to add other than there was always going to be a shift towards fees because that's the way the protocol is designed. And how those fees are achieved. So, okay, this is the lawyer and me coming out, and what can we learn from ETH is different protocols are going to have different regulatory rules around them, whatever they may be. And I think that we can learn and maybe not make the same types of calibrations and movements based on what we've seen, at least in the US on the regulatory environment. The other thing is, and I go back to the ETFs because I just want to reiterate that it's a watershed moment in the level of mainstream curiosity. I could tell you from personal experience, I've been a believer since 2017. My husband has made fun of me since 2017. In 2024, he asked me to find out how we could get a Schwab ETF piece. So all of a sudden you get the most skeptics who are interested in figuring out what it is. Once they have it, then it is, what can I do with it? And that curiosity gets contagious. And I think that's really interesting.
Yeah, there's this thesis that sort of all experimentation that we've seen within the crypto realm is going to ultimately settle back to Bitcoin, right? It is kind of the crypto, it's the apex crypto asset, right? It's the premier one. And I think that we're seeing that come to life now. You know, we've seen that NFTs that are launched directly on the Bitcoin L1 ultimately have flipped other Ethereum and Solana Bitcoin NFTs. And so I think that's what we're seeing. But, you know, we're talking a lot about building and we're talking a lot about innovation. But I would say while there is this market momentum toward it, it's not something that happens overnight. I think that we should all be sort of skeptical about things that are you know, haven't been taking a lot of research development, really thorough peer review, because there's a lot of different ways that you can build on Bitcoin. And I think that everyone should be focused on sort of the decentralization components, the security components, and evaluating these various L1s based on developer traction. You know, I think that one of the tools that we use as a primary L2 is Stacks, really due to the fact that it has been built with this long-term mindset and has built through multiple cycles, is there for the long term and sort of has these right principles and values in mind. And there's also already a community in terms of, you know, NFT marketplaces, DeFi protocols that are live. One of the things that if you've been building on the space for a while, you realize it's not actually easy to put all these building blocks together for a fully new ecosystem. It's a really challenging thing. And so a lot of these layer ones, alternative layer ones, are competing for sort of the same mind share as Ethereum, but obviously Ethereum has a really big leg up. I think that we're going to sort of see a lot of folks interested in building on Bitcoin via L2s, and they're also going to realize that sort of putting these building blocks together takes time and is a really critical part of the process.
Can I jump in for a sec? So one of the things that I find really interesting, if I take a step back and I look at just the way financial services use technology, is that this is the first true acceptance, I think, by mainstream finance of an open source protocol having value. And to me, that's a huge mind shift. So and it goes to community, and I was thinking about that as you were saying community, because open source is about community. It's about crowd contributing. It's about what John Woo said, you're building it and you might get a reward for it. Likely you will. So it's interesting to me that a world that is so closed all of a sudden took a step and wrapped its arms around something that's so open.
Thank you all for your insights. So moving on, let's talk about the Bitcoin Spot ETF. We can all agree that the Bitcoin Spot ETF approval, it totally legitimizes the Bitcoin investment space to the world. But it took 10 years for this to happen. So may I ask, what do you think the SEC's role is in financial innovation?
Can I take that? I'm happy to take that. So I think the SEC has been very, well, cautious would be an understatement. They've come out and been outright antagonistic towards crypto and put multiple enforcement actions in. Some of the crypto companies have come out swinging, and you probably saw yesterday that Consensus sued the SEC, saying it exceeded its authority, trying to get some declaration of whether ETH is a security or not. I think that we don't have the correct mindset for innovation with the regulators, and they're scared. And when people are scared, they overreact. I don't know what it is they're scared of, but honestly, if you were litigating something for 10 years, I would think that you would understand it because you'd have to in order to litigate it. So I don't think that they're doing the responsible job that they could be doing. And one of the examples, I'm sorry to be taking up so much time, but you know, I'm a lawyer, so this is my sweet spot. One of the things that really strikes me is the Bitcoin ETFs were organized under a particular set of securities laws that don't require ongoing disclosure. So you think, okay, this sounds really boring, except for I'm an investor. When the halving comes along, nobody's going to tell me about it. When ordinals come along, nobody's going to tell me about it. When layer twos come along, there's no disclosure because there's nothing ongoing that needs to be told. So where do I go for that information when I'm investing in something like this? There was no regulatory thought about the type of product that it was and the kinds of things that might be needed to help make investors safe. And for that, I give the SEC a ding.
Yeah, I don't have too much to add. All I'd say is like we can liken it and look and see what happened with the internet, where when the internet was first born, um, there was a lot of pushback. A lot of folks were saying it's really only going to be used for nefarious reasons. And then the US actually went the other way and chose to foster innovation. And now all of a sudden we have Silicon Valley, which is the tech capital of the world. And my fear is that if we try to regulate by enforcement, folks are going to find it pretty darn hard to want to jump in and start to innovate and develop new crypto protocols and standards here in the US. And what you're going to see is a lot of the industry migrate to other jurisdictions, which are actually trying to strike a better balance between protecting consumers and fostering innovation. So I think we're in a pretty tough spot right now. And hopefully we get some clear and concise rules rather than having to rely on regulation by enforcement and how like the laws which were, by the way, written 80 years ago will be interpreted by the courts.
I'm not a legal expert, unlike Susan, but I would be kind of wearing my TradFi hat, where when I was in my previous job in institutional trading of digital assets, I definitely felt that the SEC, the FINRA, all the regulatory bodies are mostly having a similar voice as the bigger banks, financial institutions. They're definitely kind of in the same arena, which might be there's interest of kind of conflict between the innovation to the old money. So I do see there's some kind of disruption that crypto or fintech are bringing into the old money space. That they may be feared of the younger generation will be more embraced, which they are. So losing users or losing their market share is definitely already seen. So they might be seeing that as a fear to explode, so they might lost control. So that's what I was comment on. So.
Great. Now, let's move on to the more technical aspect of the ETF. We've seen tremendous inflows following the Bitcoin spot ETF approval, but things have cooled down now with a week of outflows. So, how do you think ETF inflows and outflows will impact Bitcoin economics or Bitcoin price as a whole?
I'm happy to jump in on that one too. So as with any product, you get a debut and you get a spike and then you get a leveling off. So it doesn't bother me about the inflows, outflows. What I find really interesting is the people who haven't been able to participate. Pension funds, large family offices, investment advisors. This marketplace has not yet been able to take allocation. I expect that to happen maybe by the end of the year as they get more comfortable and they have created internal procedures to adopt this. But you have not, I like, you ain't seen nothing yet is the phrase that I'll use, because imagine if every pension fund took a 5% allocation. Imagine if every registered investment advisor was recommending to their client a 5% allocation. I'm sure, I'm not an economist, you guys are, but I'm sure that there is an impact on price there.
I 100% agree. I think the long-term opportunity is much larger than anybody is really anticipating. I think what we've seen so far is you saw all this pent-up demand from retail that wanted exposure to Bitcoin, and they did it through, the spot ETF when it was available, and like Schwab. And while we don't know for sure the types of buyers of this, we can look at things like the average purchase size, which, in IBIT's case was like 13,000. We could also look at anecdotal comments from the wealth managers who, in general, haven't really started to allocate client portfolios to Bitcoin and the spot ETFs yet. So it seems like it was much more retail driven. We got through that initial wave of demand. And I think what we're learning now is that this retail flows are much more volatile and much more driven by price. So when price is not going up, people are not FOMOing in. And I think now what we're seeing is like net inflows over the last 2 weeks have basically been flat. You've got like these declining GBTC outflows, but you also have declining inflows into like the 10 spot ETFs aside from GBTC. And so I think what we're kind of waiting on now is for like the wealth management platforms to actually add the spot Bitcoin ETFs as a product, and then start to actually allocate their client portfolios to it. So this is so powerful because like even a small allocation will really, really drive the needle. And I think what you could see is like literally tens of billions, even over 100 billion over time of inflows into spot Bitcoin ETF. So it is essentially this long-term TWAP bid that is going to play out very slowly, but over a long period, and it's going to be very powerful.
I definitely think there's a ton of additional price action that we're going to see for Bitcoin. But one thing that is also interesting just to sort of consider is the fact that, after the 2020 halving, I think that we saw huge momentum into DeFi summer, right? A lot of different alt L1s were coming up. And, we've never really, Bitcoin obviously has the largest amount of capital, I think still has a lot of room to grow there. But it also has reached, 60,000+. And so it's a large asset. I think people tend to continue to look for what is the opportunity ahead within this market, right? And so I think it'll be interesting to see, we're sort of seeing the meme coins on Bitcoin taking off. I think that it will be interesting to see what sort of alt L2s on top of Bitcoin can also see in terms of just general market momentum through this cycle.
Can I say something additional? I always have to say something additional. The other thing is we've just been talking about the US ETFs. Now, Hong Kong ETFs were just approved 2 weeks ago, and I think are scheduled to go live in a few weeks. I don't know the exact date. They both have okay, yeah, thank you. So they have approved a Bitcoin ETF and an ETH ETF. And so the type of investment, as I understand it, based out of Taiwan, is that certain Chinese investors will be able to invest through that vehicle. That's a pretty large market right there. So it's, we look at Bitcoin and we're talking about the US, but it's a global asset, and I think we shouldn't lose sight.
I'll just make one quick comment that on a macroeconomic side, besides the wealth management that Susan, Gina, and Brian mentioned, that's definitely going to be the next major move. But current macro environment is kind of confusing to a lot of investors. I mean, institutional investors who are saying, okay, we've seen the expectation of a rates cut gonna be was in March, and then said in May, and then June, July, right? And then now it's like September, December. So what's happening here? Like it's confusing to a lot of investors with the macro environment. So people are just kind of in a wait and see phase. And they obviously they are seeing Bitcoin as one of the major alternative assets, technology assets. So that's where they kind of categorize that as similar to a NASDAQ composite index. That's where it's kind of high correlation where it's coming from. So that's where the wait and see is coming from as well, besides the wealth management. Yep.
Interesting. Yeah, it's great that you mentioned Hong Kong because I'm actually from Hong Kong, and I was in Hong Kong for the first week of April for Web3 Festival, and there is huge crypto interest from China. So like pretty excited for what the Bitcoin spot ETF is going to do in China and APAC region. Yeah, so let's move on and talk about mining. So risk management is one of the biggest challenges Bitcoin miners have to face, since the mining profit is the difference between two highly volatile numbers, the Bitcoin price and energy price. So how do miners use traditional finance or decentralized finance tools to hedge the risk?
I'll definitely take this one, obviously. So being the economist and the mining kind of revenue management in the firm, we do look at the input and output quite closely. Input, basically the electricity. And electricity is very close related to natural gas, which was my old job, trading energy products, commodities. And obviously output is the Bitcoin, Litecoin, Dogecoin, no longer Ethereum, as a change to proof of stake. So both layers of input and output prices are very volatile. And if you haven't noticed, power price is actually more volatile than crypto, as especially Texas, and we will see regular price would be like 30, 40, $50 per megawatt hours, which is 3, 4, 5 cents per kilowatt hours compared to your home spendings in electricity. But it will go to like 100 times in the winter, like Christmas, when everybody's traveling, everybody's at home, heating up the lights on Christmas trees, and all the consumption of power, and also hitting by some snow and wind and like frozen rain. So when that happens, the price of power will go to like $4,000, $3,000 per megawatt hours compared to 30, 40 now. So it can go like 100x, not 100% in just 1 hour in that particular season. Like it's not uncommon. It's not uncommon. So it happens like 3 times over the last 2 years, at least what I've seen so far. And we will even see hundreds of dollars of megawatt hours, basically 10x compared to the average, very, very often. So that's what we will try to avoid when we have a smart switch that will turn off the machines when it's like going more than our break-even price. And will serve as a buffer for the grid, that when they are higher demand than Euro, we will definitely shut down our miners, will be yielding for the consumers that are regular, whether it's industrial or residential. So that's what we'll see. We're not that infamous compared to kind of consume a lot of power. We're definitely serving a good view for the power grid, the consumptions, that we will have that kind of massage over that peak of supply and demand of power. And speaking of the hedging, we'll use futures and OTC swaps to manage the risk from the power side, and also on the Bitcoin, Ethereum, and Litecoin, Dogecoin side. We definitely use financial institutions tools to manage to hedge, whether it's futures options or structured products, whether it's long-term 6 months or a year, or short-term 1 month, 3 months. So we will hedge when the margin is like relatively favorable, like right now. I mean, like before the halving, we have a relatively profitable margin, that 30-40% for Bitcoins and much more for Litecoin, Dogecoin. So we can kind of hedging that the margin. And then for right now, we're just hoping Bitcoin go up, right, after the halving. So we will definitely open for exposure. We are not always 100% hedged, since we obviously in the industry, we hope the industry to grow, and we always have a kind of half-ish position open for the upside potential. So I'll leave for Brian, as we had a lot of discussions on futures options trading together. So.
Yeah, I think UA and bit mining is very forward thinking. In my estimation, the Bitcoin mining industry is basically doing very little in the way of hedging. I think that they're hedging their input costs with power purchase agreements, PPAs, but I don't think they're doing too much in the form of hedging price and hedging network hash rate. Luxor just developed this really great product and starting to really push this along with basically hash price NDFs. But I really think when you think about it, traditional commodity producers like E&Ps are essentially the same thing as Bitcoin miners. So you have a lot of upfront CapEx, and then you are going to be producing this commodity asset in the future at an unknown price. And pretty much, I want to say like 60 to 80% of all E&Ps hedge at least some of their future oil and gas exposure. And so I think that there's plenty of room for Bitcoin miners as the industry matures to adopt best financial practices. There's really 3 benefits to doing so. One is going concern protection. So what you saw in the last downturn is a lot of miners actually went out of business. And it's because the construct of Bitcoin basically encourages this hash rate arms race. And so basically, if you don't add hash rate, you're going to produce fewer Bitcoin. And so what that leads to is everybody wanting to add more hash rate. And a lot of times folks get over levered. I think right now the miners have learned their lesson. They're all hitting like their ATMs and they're building up this war chest for the halving that we just saw. So they've got a lot of cash on hand to, in case Bitcoin's price dips, they could survive for a while. But one is going concern protection. Number two, you can improve your forward economics quite considerably. And so right now, it's kind of impossible for a miner to know whether when they buy, a new site or a bunch of rigs, whether that has a positive ROI or not. And that's because that future ROI depends on these exogenous variables like the future price of Bitcoin and the future network hash rate. And if you can then go in and start to hedge some of that, you can actually start to know what your ROI is going to be ahead of time. And so this is super important. You can actually I covered banks. All banks are happy to lend to E&P companies, but they force those E&Ps to actually hedge their future price of oil. And so they actually have engineers on staff. They'll go out and they'll visit the wells. They'll say, you have this much oil underground. And because you are now hedging the future price of that oil, I know the price that you will get for it in the future. And it essentially converts this asset-based loan to a cash flow-based loan. Then of course they discount it. But so these E&Ps can basically borrow from a bank at a very cheap rate versus having to hit the equity markets, which is very expensive. So that's number two, improved expansion economics is really important for miners. And then the last one that I think people don't really appreciate yet, and this is me putting my equity analyst hat back on, is I really think it would be multiple accretive. So right now, my sense is miners trade with this large uncertainty discount. So let's say a public miner puts up 100 million in revenue this year. It basically tells you nothing about the revenue next year. They could be out of business or they could put up 400 million. So investors, what type of multiple are you going to award for this year's 100 million? It's going to be pretty much discounted. And so the three things in my experience that impact multiples are profitability, growth, and earnings visibility and volatility. And unfortunately for the miners, that last one is really tough. And I think hedging can really significantly improve that. And so in my mind, this would add a couple turns at least to the multiple when miners start to really utilize some of these hedging strategies in earnest.
I can't speak to hedge.
Yeah. Right. Thank you all for your insights. And actually, Mr. Brian Rudick published an essay on Bitcoin hedging on GSR's website. He built crazy financial models for that. So I encourage you guys to check it out if you're interested. So the last question, I'll direct this to Ms. Gina Abrams, is we have seen this trend of building on Bitcoin with the development of BRC-20s, ordinals, inscriptions, and now runes. So what should developers build on Bitcoin, and how is building on Bitcoin different than building on other layer ones such as Solana or Ethereum?
Yeah, thank you for the question. As I was mentioning before, I think that pretty much anything that is being built in the Web3 space really kind of belongs in the Bitcoin ecosystem, right? I think there is just a ton of opportunity in terms of the fact that not many people are actively deploying their capital. And so that's something that we're definitely looking at from the Trust Machines perspective in terms of building out not only the onboarding paths such as Lether, a Bitcoin wallet, but also thinking through Bitcoin liquidity protocols. How are people going to actively participate in DeFi? And so I think that there's a really large open space here. And I think when we consider this industry as a whole, Bitcoin is freedom technology. And so let's think about what are the use cases that continue to move that mission forward. I think, we're going to probably see more experimentation around things like Bitcoin-backed stable coins, allowing for there to be more parties than just Circle and Tether, and having sort of more redundancy in these really important verticals. I think that folks are really interested not only in those DeFi experiments and yield-bearing instruments, but also thinking through, okay, when it comes to sort of these assets that we're creating in the Web3 space, when it comes to our digital identities, when it comes to digital art, provenance is actually really important. And so let's build it on the best Bitcoin blockchain. Let's build it on Bitcoin, right? So I think that there is so much opportunity within this ecosystem. We're able to take a lot of the learnings that we've seen from other Web3 experiments and ultimately deploy them into Bitcoin. I will say that I think there's still work ongoing to just improve the user experience for folks who are building on top of Bitcoin. There's a few different upgrades that are in progress, within the Stacks ecosystem going live later this year with really the primary targets being to improve the user experience in terms of transaction speeds, and then also really making it super easy to deploy Bitcoin into these layer twos. And I think that we're going to see a lot of interest in deploying that Bitcoin capital, potentially porting it to other chains, and yeah, seeing how we can build with Bitcoin in a decentralized manner.
Cool. I guess those are all the questions for today. Do the audience have any
I have
questions?
something else that
Of course,
I think.
of course.
Sorry about the cough before So one thing that we get that right. One thing that we didn't talk about was renewables. And I think renewables and community revitalization. And I think those are two critical stories for Bitcoin and will be critical for the layer twos as well. So mining is moving towards renewables in a really interesting way, right? They're taking landfills and converting them to energy. Think about what Bitcoin mining is. It's a very, very, very large number of servers, right? It's a data center essentially. I think every data center that consumes a lot of energy, Gen AI, et cetera, can learn from renewables and the cutting edge research that the Bitcoin miners are doing. And I don't think that that is something that people really know. The other thing is, as Bitcoin miners go in search of cheaper power, they're generally finding these communities that have been sort of left for dead. They're going in and revitalizing these communities by putting a new industry in that's a high-tech industry and training them, training the folks around it, becoming the largest taxpayer, a very large part of the tax base. I think that economic revitalization is also a story that isn't told, and it needs to be told because Bitcoin mining gets demonized a lot for its energy usage, but there's a lot of good stories that should be said as well.
Thank you for bringing it up, Susan. I will definitely comment on that. Our data center is in Akron, Ohio, which is in between Columbus and Cleveland, which is a small town. The population has been declining, especially Cleveland, and mostly are jumping out of the city to other places, especially in the pandemic. But since our launch in that city, and we have been hiring quite a bit from local schools like Kent State, University of Akron, Cleveland. So we did hire quite a bit of computer science students and also engineers, operations from the local community, at least like 30-ish people there. So we do support the local community and also the energy side. The current consumption we have in Ohio is roughly 1/3 nuclear, 1/3 old energy, and 1/3 new energy. So we definitely want to improve that more, and we have been working with the power companies and the grid to try to having more input from the new energy, and that's not only a responsible thing, but also we want to be forward thinking in terms of embracing the new energy and also making Bitcoin greener.
Yeah, my two big learnings with respect to Bitcoin's impact on the climate is really this. One is it's easy to look at the Bitcoin network and say, hey, it uses more electricity than Argentina. But I think what folks do is it's really easy to conflate electricity usage with emissions. And because Bitcoin miners are over-indexed towards renewables, their actual emissions footprint is much less than their electricity consumption would suggest. My second big learning is that because Bitcoin miners have this huge incentive to go where power is cheapest, what we're seeing is increasingly the cheapest power is renewables. And like these Bitcoin miners can actually serve as like this steady base load where they can partner with like a new power supplier company to actually build renewables and develop it where it otherwise wouldn't have been economical, because essentially like that Bitcoin miner can easily shut on and off like its rigs when, you know, the wind is blowing quite quickly and, you know, there's producing more power than what's needed, because that's occurring at night and things like that. So I actually think like Bitcoin as a whole actually encourages renewables development.
Yeah, Alex Gladstein at Human Rights Foundation has this great quote, "Not mining is wasteful." Just
Exactly. To kind of echo those, you were saying that the green energy or the renewables definitely like we're kind of a complement to each other with mining, because they're not that reliable yet, because the solar, the wind, and the hydro, it's seasonal, and miners can be on off. Right, so that's a very close complement to each other, that we can kind of follow in the flow of energy, and then they can sell the more stable side of power to the kind of traditional industries, and then giving the more volatile supply of power to us as miners, to as with buffer as the energy supply.
Thank you all for your insights. I'm pretty sure me and the audience learned a lot about Bitcoin, like Bitcoin halving, like ETF, and builder community and Bitcoin. I want to like thank you all again for speaking on this panel, and thank you the audience for being here. So yeah, if you guys have any questions for the speakers, please direct them outside the hall, because we'll be hosting another panel in a few minutes. Yeah, thank you.